Welcome back, Adam here. Today I'm looking at changing from a limited company setup to a sole tradership. This is one that happens fairly often, as many people starting out in business for various reasons, which we'll cover shortly, think that a limited company is the better option, only to later discover that it isn't always the case. So let's look at why this is, and if you do find yourself in this situation, what you'll need to do about it. So although there are a few different setups that you can opt for when starting a new business, typically there are two very popular options that will spring to mind. The first is sole tradership, which is widely regarded as the most simple form that a business in the UK can take, and with around 3.2 million sole traders in the UK, it's also the most popular. The reason for its popularity stems from its simplicity. A sole trader is essentially trading as themselves, so as you can imagine, there isn't a huge amount of paperwork or red tape needed in order to do this. Simply register online with HMRC for free and you're ready to start trading. Sole traderships also benefit from low setup and running costs. Now, I've already mentioned that it is free to set up as a sole trader. It can also be comparatively cheap to run too. Because of the more simple taxation rules that apply to sole traders, you have a much better chance of managing your own tax affairs, and even where you do require the help of an accountant, it won't usually cost an arm and a leg. There's also minimal paperwork. Of course, you still need to maintain accounting records, but compared to a limited company, the burden is greatly reduced. As for the limited company, there are around 2 million of these registered in the UK, making it the choice of entity for 37% of UK businesses. It's popular because of the additional protection that it gives its owners. The limited company is a separate legal entity and therefore protects its owners' personal assets in the event that the company were to get into financial difficulty or experience legal claims against it. It also offers increased control over distributions. Now, if you run your business via a limited company, you'll often be able to distribute funds to yourself in a couple of different ways, either as a director's salary or as a shareholder dividend, or in most cases, a mix of the two to ensure maximum tax efficiency. You can also determine the timing of these distributions, which leaves more scope for effective tax planning. Of course, the company will still need to pay corporation tax on its profits, but the limited company is considered to be a more tax efficient option by many tax professionals. There's also the perception of a more professional image. Due to the additional requirements and checks that are required in order to run and set up a limited company, this setup has a reputation of being more professional to deal with. Now, the point that most business owners will focus on first will usually be tax efficiency. After all, most people want to keep hold of as much of the money that they earn as possible. So let's look at the difference in tax efficiency between the two setups. Sole traders will be taxed under income tax rules. The individual will have to complete a self-assessment tax return each year and pay income tax and national insurance on any self-employed profits that were generated in the tax year. Income tax rates vary from 0% through to 45%, depending on how much you earn. And Class 4 national insurance is applied at either 6% or 2% as shown. As for the limited company, profits will initially be taxed under corporation tax rules. Currently, corporate tax involves a small profit rate of 19% and a main rate of 25%. Following this, you'll still need to extract the remaining profits from the company, either via a director's salary or a shareholder dividend. If you choose a salary, income tax rules apply again, and potentially national insurance, although this is where the control over distributions comes in handy. For example, if you have personal allowance remaining, you can pay a salary to yourself to the point that it would be covered by this personal allowance and therefore tax-free. Any additional income might then be taken as a dividend. There is currently a small tax-free dividend allowance in place, and then following this, dividends are taxed at a rate varying from 8.75% up to 39.35%, depending on the income tax band that they fall into. So given this, you might well be wondering, is the limited company actually more tax efficient? And the answer is a very diplomatic sometimes. As a general rule, the more profit a business makes, the more likely it is to benefit from the control over distributions that a limited company structure offers, whereas a smaller business generating a lower profit will see less benefit. The table on screen now shows an approximate saving that an individual might make by operating via a limited company rather than as a sole trader. It uses historic tax rates and thresholds, assumes a single director with a salary up to the national insurance threshold, and remaining profits distributed as a dividend, and no other taxable income. You can see that for sole traders with lower profits, the tax saving offered by switching to a limited company setup isn't as significant as you might think. On top of this, you also have to consider the additional costs that may be incurred when operating a limited company, which is going to eat away at any small tax savings. So if you are looking to switch from your existing limited company structure to a more simple sole trader setup, then the process that you would need to follow consists of two main steps. The first is to cease trading via your limited company. For most, this will involve closing down the limited company by filing a final set of accounts and corporation tax return, settling any liabilities such as PAYE, VAT, and supplier invoices, disposing of any company assets, and distributing remaining funds to shareholders, all before striking the company off the register at Companies House. The second step would be to register your self-employment with HMRC, which will ensure that you are able to report your profits via a self-assessment tax return and pay any resulting tax liabilities. This can be done online by creating a government gateway account and registering a new tax. You wouldn't necessarily need to wait for step 1 to be complete before completing step 2, as the close down of a limited company can be a time-consuming process, and you'll want your trade to continue the entire time, irrelevant of the structure that's being used. What you will notice is that there is no real formal process to transfer your business from limited company to sole tradership. It's just a case of closing down one and starting up another. This is slightly different if you were to move the other way from sole tradership to a limited company, as incorporation relief allows for the tax-free transfer of assets when a trading business's structure is changed in this way, meaning it's widely considered to be an easier process and supports the idea that most startups would be better off beginning life as a sole trader and then potentially incorporating once the business is more established. That is all for today. Thank you for watching. See you next time.